The fix and flip is a one-time hit. Granted, it could be a great hit.
Right.
Okay. And you need to do a certain number of those if you've got overhead. But if you're doing 3 or 4 or 5 of these deals, target one of them to be a seller finance type. And the reason being is you're kind of stockpiling back here so that you've got residual wealth and income cash flow coming later on down the road is what you've got.
Welcome to the Freedom Podcast. I'm your host, Homero Corona, and today we have a very special guest, Mr. Jay Redding, who has been an extremely successful real estate investor that has been investing since actually before 2008. So he's been through the downturn, he's been through the cycles, and he's got a lot of wisdom to share with you guys. You can't miss it. Stay tuned. We have a lot of insights, especially if you're wanting to get involved in mortgage note investing. Welcome, Jay. I'm excited to have you. Let's go ahead and take people back on who is Jay and how you got started, because I think you have an incredible story from farm boy to a successful real estate investor. So welcome.
All right. Well, thank you so much, Homero. I appreciate that. It's always great to be with you. Great for us to have a chance to talk. So, I basically grew up on a hog and dairy farm in the middle of nowhere in Indiana, on a 200-acre farm. My parents were farmers, and grandparents were farmers, and that's kind of where my roots were. I learned the value of hard work, certainly, at that respect. And my brother, who is older than I, is 13 years older than I, we were the first generation in our family to go to college. He is a grad of Purdue, so it's always an ongoing discussion here. But I went to a small school in Indiana as far as college. I ran cross country and track, high school, college, and also coached collegiately for 5 years, Division I.
Wow.
And then got involved with pharmaceutical sales, all right, and did that for 17 years. And then I was doing some real estate investing on the side and got downsized in as far as the pharmaceutical position and just decided to go full tilt. And that all started, did my first real estate deal in 2004, went full time 2007, and did a whole bunch. We've done over 100 fix and flips and bought a lot of tax liens. We were up to as many as 45 rentals at one time, self-managed. My son-in-law came on board. He's been with us now. He came on board 2014. So it's just basically he and I. So, and then 2019 is when we started getting interested in the note space for a couple reasons. I have one child, and he's married to her, and so we know where everything is going. And we were having that discussion as far as, what's this look like for, generations, for the next generation, that types of thing. And he decided that he doesn't want to be a property manager for the rest of his life. And we got that. So we really started looking, what really appealed to him. And so he is really the one that got us involved with the notes, that he had an interest. And I said, all right, let's go and see who's out there, who's doing it, who's been doing it, and is still doing it. Okay.
Right.
And that's how we met with each other in that respect. And what we're basically doing now is we're transitioning all the rentals from us self-managing over to property management. And that's a gradual process. And we've been building out the note business is what we've been doing.
Awesome. So, for, people that are listening and watching, just like I was, in 2017, 2018, when I wanted to get started in real estate, right? Before I did my first deal, I would talk about it all the time, right? You got to do your first deal before you do your 10th deal.
Yep.
And the hardest one usually is that first one.
And you learn so much in that first one as well.
So if you have, let's talk a little bit about how you got maybe your first deal, and then maybe how you got your first note, and how that's dramatically different.
First real estate deal?
Yeah.
Okay. Yeah. I was actually working for a pharmaceutical company at that time, and through happenstance, more than anything, came across a property. Actually, we still have that property as a rental.
Oh, wow.
I was looking for a rental, and the realtor who had it, through the discussions and everything, found out that she grew up in a real estate family, contractors. So it was like perfect.
Right.
I had my person who could do the design, who could get the contractors and and that's basically how we worked for a number of years. She always took care of the color schemes and the making sure the kitchen was designed right and the fixtures and all that because I stink at that. Okay.
Right. Yeah, I do
just,
too.
Yeah.
I
It's
do
just
too.
not my strength.
Yeah.
Okay. And then we ended up getting a general contractor on board who would do most of the work and we'd get subs out then as we needed. And so essentially, we'd come into every deal, but I'd run the business side. She'd run kind of the design. All right. And then he'd tell us, all right, what it's going to cost. And that's how we basically made our decisions. So that was 2004. All right. And I was working full time yet at that point, and she basically ran the job sites.
Right.
Okay. So she did. And it worked fine. And then I kind of came in then in 2007 when I came full time. I kind of came in as the general, coordinating everything
Right.
and make sure that everything worked in the right order and stuff. And yeah, that's how we got rolling.
I mean, I think that's a great story and a great example because a lot of times when we get started in real estate, I know for whatever reason, as an investor, a lot of investors have the mindset of, I want to save on everything, do everything. But in your case, you saw a lot of value in somebody that had experience running the show, basically, where, you were investing, you were still at your corporate job, right?
Yep.
And it was a great relationship to where, for people that have no experience and you're out there trying to find contractors when you first get started, I mean, there's a lot of nightmare stories of,
Yes, there is.
So having somebody valuable that has the experience already, it's good to pay them what they're worth because they're worth their weight in gold and, can take a lot of the headaches right from the beginning, right?
Yeah, I mean, what we basically, whenever I would purchase from the realtor, we basically, she was my representation as far as when we would go and buy, and then she would put the design together, and then we would let her sell it then also. So she'd get commission on both ends, all right, and that's how she made her money, all right. As far as the contractors were concerned, we basically put a scope of work together, and they give us bids basically on what it would be, so we knew whether our budgets, and sometimes we had to negotiate or whatever. I mean,
Right.
It's all part of it. And what we can and can't do for the money that we have set aside for the rehab. All right. And probably the best thing that we did so that we were consistent across the board when we were really starting to flip is that we basically put a worksheet together. So literally when I walked through a house and we were looking at the house to determine whether it might fit or not, we already had the numbers for, okay, if we need to do a kitchen remodel, what's that going to cost? All right. We need to do paint for a 1,500
You
square
knew your
foot.
numbers.
We knew our numbers. Yeah. And if you're just getting started, all right, you don't know those numbers. It's worth sitting down with a general contractor and help them give you a guidance from which to start with. As you go along and get more experience, you're going to tweak those numbers as you feel more comfortable, and you'll know when to tweak them. Okay.
Right.
When you need to add a little extra in. All right. But starting out, you got to rely on people who are experienced and get the numbers that way. And then, and now you can also use averages out of ChatGPT or AI stuff to get ballpark figures to make sure that you're
In line.
not getting hosed, all right, and by someone. So, that's basically how we got going.
What would you say was your most valuable lesson going through the time that you got started into getting all your rentals and going through that phase of, fix and flipping, buying rentals?
I know one right now. Always check the roofs. And in the winter, don't assume. All right. I'm in a northern climate, so obviously we have a fair amount of snow on the roofs, and we did a fix and flip. We did not lose money on it, but we sure didn't make any money on it. I thought was going to. I looked at it from the ground. I didn't get up on top of the roof. I had a little bit of snow on it, and did not really look at it closely. What I thought was only going to be a minor repair ended up being a full tear off and re-roof, and the numbers were tight. God bless my wife. She and I redid that entire roof.
Oh, wow.
We did not lose. We made $1,500 on that deal. Okay. That was a huge lesson learned. All right. Because I was too lazy to get up on that roof.
Yeah.
And that, you make mistakes like that. Fortunately, it did not cost us. Cost me a couple of nice dinners for my wife, definitely. But she grew up on a dairy farm, so she knew it. Yeah, she knew how to work as well. Yeah. But unfortunately, it was only a one-story home. It wasn't a two-story home or anything. So the roof was not steep. So, but yeah, we did that one ourselves. That was a big job. Yeah, learned a big lesson on that one. Yeah.
So I mean, I think we can, we've
all had those mistakes.
We've had our fair share of mistakes, and they're gonna come. I mean,
it's part of learning.
My very first house I flipped. I mean, you're gonna think this is silly. People that are watching this is like, if you know me, if I know one or two things, I'm gonna take action on those one or two things, and there may be 30 other things that a lot of people say, well, I got to figure 30 things out before I get started. My very first flip, this is how I guess you can just say dumb and naive I was. I'm sitting there with the plumber, and I'm like, hey, the toilet's not flushing. It's not working well. And this is a 1960s home. And he's like, let me show you the camera. Let me show you what's going on. This is called cast iron, And I'm
was this the green toilet or the pink toilet or the, blue toilet? Those are the 1960s.
Yeah. And it was just a regular toilet, but I just hadn't budgeted for that. And I just figured, okay, this is going to be a $1,500 repair. Not $12,000-$15,000,
sewer line issue, yeah.
However, I still made out okay because I bought that property for $30,000 and I ended up getting a second lien with the lender to make the numbers work. But yeah, I mean we've all made mistakes.
Yeah, it is the price of education, right? What it is, and each one you learn. The other thing that you're going to learn is that on every flip, you can put all the budget together, and there's always a surprise. Yeah. Always budget for a surprise. And many times there's 2 or 3 surprises, because a lot of times you just cannot tell what all the issues are till you get into the home and really start opening the walls up or doing the things that you have to do. And those, a budget can get out of line real fast. So you have to kind of plan for some of those things as well along the way.
Yeah, no, for sure. And I think we can all talk about there's a lot of pain right now in the current market. If we fast forward, we'll get into that here in a second of all the things and data that you've seen over the last, couple of months. Before we get into that, what was your transition from, just owning only rentals to being open enough to say, what, this note business may be the way to go?
Well, we could sense that there was definitely a transition that was taking place in the market. The flip margins, at least in our price ranges where we were working, were getting tighter and smaller. And between that combination and then my son-in-law, Kyle, wanting to have an interest in it, it's like, okay, I was familiar with notes. I had actually taken a note course a number of years ago, but just really had not implemented it into our operational, operational thought process.
Right.
And so we started digging into it, learning it a lot more. It took us a year or so to really get a handle on it. And we were really trying to figure out, all right, how can we make a business model out of this? And that time, partials were really being promoted heavily in that respect. And we just couldn't get the partial model to work for us because we need cash flow off of them. Okay. The partial model is a fantastic model for particularly self-directed IRAs. All right. We're managing right now about 70 notes is what we're managing.
Wow.
And we got like 15 or 16 in the self-directed IRAs, and we'll partial those. Okay.
Right.
Out. But, so what we finally dawned onto, there's proof that anyone can do this business. Because I've been in real estate for at that point probably 15 years, and it didn't even dawn onto me. It just finally dawned onto me one day. Listen, we've used private money for all the deals that we've done. Why can we not use private money on the note side?
Right.
And utilize the hypothecation method. And it's like, duh. All right. But it was a year before I even thought about that. Yeah. It just hadn't even crossed my mind. So There's hope for all of you. Okay, just so you know.
Yeah, I mean, sometimes the answer is right in front of you.
Yeah,
Right?
it was the whole time. So
Yeah.
I consider myself not necessarily the dimmest watt in the box, but I kind of was on that one. So,
Yeah.
but no, we started buying. We buy full notes, we buy partial notes, and then we turn around and hypothecate them out to our private capital is what we do. And we take an arbitrage is what we basically do on that. So we've been doing that now since, we're really strong here in the last 3 years.
Yeah.
And have been going after it pretty strong. And we've worked to align ourselves with house buyers that sell on seller financing, someone like yourself that's doing some fix and flipping and they're selling seller financing. And we're showing them a way to create a better note and a way to give them an exit strategy that they don't have to sell the entire note. They can get out of a deal. They can make some money now, and they can make a lot more money down the road if it's structured correctly. So that's what we basically do.
Yeah. Let's just take a couple of, minutes to discuss and explain to people that are watching, because I know when I first was getting started, I'm like, this whole note space, there's so much information on it, believe it or not. And there's things that you're able to do that, I just wasn't aware. And you start really digging in to find out that this is how banks operate, right? Like, so let's take a minute. So explaining a little bit about what is a mortgage note and what part of the, because there's a lot of different mortgage loans, right? And what we focus on and how a partial works.
Sure. All right. So a mortgage note is, or a deed of trust, depending upon what state that you're in.
Right.
You have the promissory note. Okay. That is oftentimes called the note, which is essentially the terms of the payback. All right. For the amount of money that you are borrowing.
Right.
It determines what the terms are, what the interest rate, what the monthly payments are, and when the end point is. All right. As collateral, then, depending on judicial states, it's called a mortgage. On non-judicial states, all right, it is a deed of trust. And that is the security instrument that secures the loan. So if you default on the promissory note, we can take the collateral, which is a house or land, or it could be many other things.
Right.
But as a mortgage, it's going to be a house or the land. As the security to take that back to make us whole. So the mortgage or the deed of trust is the security instrument, and that's recorded in the recorder's county recorder's office. And then you have the promissory note, which defines the terms of the payback and how to be paid, etc. Okay.
Right.
Now, when we come in and buy a promissory note, could be 10 years, it could be 20 years, 30 years, and it could be any length. All right. What we will do is come in and purchase a certain number of payments for a certain dollar amount. You say, Homero, I just did this deal. I need $100,000 to get my private lender paid off. All right. And to make a little money now. All right. We would come say, okay, depending upon the value of the property, assuming that the value of the property is high enough that we have an equity position to protect us, we would come in and pay you the $100,000, and in return for that $100,000, we will collect the next 125, 130 payments of that loan.
Right.
At the end of that 130th payment, the loan reverts back to you as you being the owner. You still are part of the equation. You haven't lost control, but you have sold off the front part of that loan and has a remainderment on the back end.
Right.
And when it comes back to you, you're entitled to all of the interest on the back end, all the payments, all the principal paid out. And most on standard loans, most of the upfront part is interest.
Right.
Okay. So you're basically selling off the interest on that and then getting principal plus interest back on the back end is what you're doing.
Yeah. So simple example, it's a $200,000 loan, and you buy $100,000 partial, 10 years, 12 years, 15 years down the road, that person's still going to get a decent amount of income, and or they start getting those monthly payments. And that was intriguing for me, as a fix and flipper. And I say this all the time. I haven't met very many or any excited, successful fix and flippers that say, I want to do fix and flipping for the next
Rest of
30,
my
40
life.
years, rest of my life. You get burnt
It's a young man's game.
Yeah. Trust me. It may be your fifth year, your first year, your first flip, your 10th flip, your 100th flip. You're going to get burnt out and tired. And that's the thing, is that once you sell that property, that's it. You're not making any more money. And that's the thing about notes is
It's a one time. The fix and flip is a one-time hit. Granted, it could be a great hit.
right.
Okay. And you need to do a certain number of those if you've got overhead and you're propelling. But if you're doing 3 or 4 or 5 of these deals in a month, or depending on what size of operator you are, or even in a 3-month or a 90-day period or something like that, target one of them to be a seller finance type. And the reason being is you're kind of stockpiling back here so that you've got residual wealth and income cash flow coming later on down the road is what you've got. It was interesting. I spoke about 2 weeks ago at a national conference, and there's probably 150 people in that room, and they were all real estate investors. And I asked the question, how many of you have ever created a note or a land contract or anything like that? Everybody. Literally everybody in the room had raised their hands. Okay. This was a pretty experienced group. Yeah. I asked them, how many of you have sold a note to a note investor or someone like that? Only about a third of the hands came up. And then I asked the final question, how many of you know what a note investor looks for? There were 5 note investors in there that I knew, and those were the only hands that went up.
So nobody knew.
Nobody knew what a note investor is looking for. If you don't know what a note investor is looking for, how can you structure a note that gives you liquidity?
Right.
Okay, so that you can sell it. And that's the whole disconnect that's in the industry right now. You've got the real estate on this side, you've got note investors on this side, and it's like, no one's really knowing what
each other want.
Yeah. It's 2 sides of the same coin, but you need to know both sides, because if you create a note, oh my gosh, you've got all kinds of flexibility things that you can do. If you're doing a fix and flip, you've got liquidity. You can sell on seller financing. You don't have to sell the whole note. You can hang on to it if you want. If you got a rental, you've got a rental. Hey, I am just tired of rentals, or they're not cash flowing anymore. You can now create a note. You can push out the capital gains over time, all right, which helps you from a tax aspect, and you can still get ongoing cash flow, because the cash flow of a note is going to be about 2.5 times more than what the rentals are performing right now.
Right.
And you got long-term cash flow, and you're harvesting your capital gains at the same time. If you've bought subject to, okay, and all of a sudden that subject to's gone bad, the bank's calling that due. If you've created a good note, you can sell a partial of that note, pay out the underlining, and you're good.
Right.
Okay. If you have a crappy note, you don't know what you're doing. All right. You're going to take a huge discount, or you're going to sell the whole thing. You've lost the deal. So it's really, really important that you talk with note investors. I firmly believe every real estate investor should have, I'm going to date myself, every real estate investor should have a note investor, at least one that they can talk to about creating it, that's in their Rolodex. Okay.
Right.
Now just in your cell phone and contacts list. But, you have to have the ability to go on both sides of the coin, because you don't know where the market's going. This is a tough market right now to make rentals cash flow.
Yeah.
All right. And the reason being is because, the appreciation of the properties have gone up, all right, threefold, all right, over the last few years. Expenses have, doubled or tripled. Okay. Taxes, our own property taxes in our portfolio, which we track over the last 4 years, they have tripled. All right. Cost of everything, but your rents have not tripled.
Right.
They've increased. I don't disagree, but they've not matched the inflationary because of the financial constraints that are out here. And as a result, landlords are getting squeezed right now. I am very fearful of new real estate investors right now getting into a deal and wanting to buy rentals, and they're automatically just accepting what many of the gurus are talking about out there. Do the BRRRR method. You get 70% out. You may not be making enough cash flow to afford that payment.
Right.
All right. And what if I lived through the Great Recession? I flipped all through the Great Recession. All right. Our average hold time was 8 months from the time of purchase, rehab, and retail sale. All right. And now everybody freaks out if it's on the market longer than 30 days. I mean, we're not even to a normal market yet right now.
Right.
But what happens on that rental if we start to go into a recession and now your rents pull back? It happens.
Yeah.
Rents don't always go up. Yeah. And it's like, for a number of years, we've been in this acceleration, and many of the young people that are in this deal, they've never experienced a downturn. And if, Warren Buffett says, you know who's flying naked when the tide goes out. And my concern is there's a lot of real estate investors right now that are swimming with no trunks on. Okay. Yeah. And they just don't know it yet. Right. You gotta know your numbers unbelievably tight. And cap expenses, when you're calculating, most people are way underestimating what cap expenses are, because those have skyrocketed.
Yeah.
All right. If you've not ever figured out how to do what your cap expenses are, look at your rental, look at your roof. How many more years do you have on that? If you don't know what the cost is, go to ChatGPT. See however many square it would be for your roof, and what's an average price for that.
Yeah.
Whatever that price needs to be factored into your equation over the next however many years. And you got to be disciplined enough not to be tapping into it, or else you're not going to have the money to replace that roof.
Right.
All right. Or it's going to be in a situation you're not going to cash flow. Now you've got to supplement it from your other sources of income. That's a tough situation to be in. Okay. And there's no room for error when that starts.
Yeah. And I mean, the reality is a lot of people got painted a picture of get into the real estate rental business because of a cash flow, right?
Yeah.
People get into it. Remember, why did you get started in real estate investing? A lot of times you ask people this question and they're like, oh, I bought rentals because of cash flow. Yeah. And then they realize, I'm not really making any money. So if you are looking for cash flow, you need to start digging into mortgage notes. Yeah. And there's so many ways of getting involved, whether you're originating, creating notes, buying partials. But I love your model on how your investors are getting above average returns. Mm-hmm. They're secured. And you're still making a monthly spread and increasing your cash flow.
That we are.
So if you're finding this conversation interesting, feel free to reach out, and we have some free resources. You can go to notesinvesting.com. We have some PDFs, some trainings. If you'd like to buy a note, sell a note, talk anything notes related, you can send me an email at info@notesinvesting.com, or just go to our website directly and get some free resources.
One thing I think it's really important, if you've got rentals out there, okay, you need to really understand, if you don't know what a cap rate is, all right, cap rate is essentially the net operating income of your property divided by the valuation, okay, or what it's worth. The important thing to remember here, you have to be honest with yourself. Okay, you can tell yourself lies, all right? Be honest with yourself. What is this is before debt service, so it's your net operating income divided by valuation. You know what the average cap rate right now is in America as far as rentals are concerned? It's 4.5%. Okay. It used to be, I bought a lot in the 2008, 10, 12. I was buying at cap rates at 20, 22%, wow. 18 to 22% was what I was buying at.
Yeah.
Okay. Those properties now we have free and clear. Okay. So we can absorb a lot. But if you're buying, and I'm going to ask you, if you're making 4.5% return, why are you dealing with the headaches of being a landlord? You could just go put it in a CD and make 4%.
Yeah.
There's no sense of that.
Right.
Okay.
Getting calls at 2 a.m.
Or
You know, dealing
just
with-
the
yeah.
tenant turnover trash,
Right.
you know, and then you've got a situation where, okay, you got a tenant that trashes your property. Now you've got to put $3,000, $4,000, $5,000 into it. And now I don't get any cash flow out of that for the next year. You can't pull a dime off of that property until you get that recouped. All right. Or say they really tear it up and now you got to put 20 to 25,000 into it. Because that's what it costs. A rehab that we used to do for 8 to 10,000 is now 20 to 25,000. Same exact
All day long.
Yeah. So you really not bashing rentals. I have them. Okay.
Right.
But you have to be on top of your game. You have to know your numbers down to the penny.
And I think you have to be honest with yourself more than
Yeah.
anything. You have to be honest that you got to look at your numbers.
Yeah.
You know, you may be thinking you're making $600 a month cash flow when in reality,
you're really not when you look at what your CapEx
Right.
expenses are, your property taxes, and insurance. Insurance has certainly increased,
Right.
just like everything else.
Yeah.
It's like, it's. There are still pockets in America,
Right.
all right, where you can still cash flow, but you got to know where those are at, and there's still deals out there. I'm not saying
Right.
there aren't deals, all right. I'm still a believer in rentals. I'm not bashing them from the standpoint of they are a great wealth developer, but you got to get into them right and you got to operate them right. That's what you've got to do. And I just see too many people right now getting into it and getting over leveraged, and there's a hurt coming.
Right.
I mean, there is a storm that is brewing right now. All right. Why do you think insurance has increased? Because of all the catastrophic things that's happened in this country. All right. Why do you think property taxes have increased? They've increased because of all the appreciation. Why do you think all the appreciation took place? Because of all the free money that was pumped into the system right now.
Yeah.
It's all converging at at the same time. The other thing that's happening right now, there's a lot of commercial debt. All right. That was originated in 22. All right, that are on 3, 5, 7-year arms. A bunch of that's starting to come due right now.
And they can't.
They were originated at 3.5% interest rate. Now they're looking at 7 to 8%. It penciled out number-wise at 3.5. It doesn't pencil at 7 because they've gotten squeezed, particularly in multifamily. They've gotten squeezed, all right? And as a result, banks are having to absorb, make some really tough decisions. Their underwriting's getting tighter. Money's not nearly freely available as it once was in that respect. And you just look at all the different factors that's kind of converging at the same time. Air is going to come out somewhere. I don't know when. I don't know where. All right. But you need to be preparing for the storm now.
Yeah. And we're in the storm right now.
We're in the
too.
storm.
We're in the
We
storm.
are in the storm.
I mean, there's so many people that I talk to.
I think we're in the front edge of the storm, but we're
yeah.
definitely in it right now.
No, for sure. There's a lot of things going on, and there's a lot of and I talk about this all the time with people that are thinking about getting started in real estate. That I'm like, human psychology is interesting, right? Everybody wants to get involved in crypto and Bitcoin at all-time highs. Did you see Bitcoin? It's $125,000.
That's crazy.
You need to invest, and everybody invests there. But when it goes down, nobody wants to invest. Real estate's the same way.
Yeah.
Everybody and their mom was getting their real estate license a few years ago, and now we're seeing a dramatic, decrease in real estate agents over the last couple of years. They're going back to regular jobs. But I tell people, when do you think there's more opportunity? Do you think there was more opportunity in 2008, 9, 10, 11, or more in 21, 22? Yeah. You got to get involved now. So for somebody that's looking at this video right now and they're thinking about get started, or if you had to start from scratch right now, Jay, what would you be doing? Knowing what you know now, what would you be doing? What would you be involved in this current market? Would you just sit on the sidelines? Would you not do nothing? Would you wait? What would you be doing?
I'd be doing 3 things. We bought a lot of tax liens over the years. I still like that market. The pricing got a little wonky. Okay. like everything else. But I would be doing fix and flips. I would still be doing that in the right markets. I mean, you've got to dial in your numbers really well, but there's still opportunities out there. So
Right.
I would be doing some fix and flips, but I would be doing seller financing as my second alternative. All right. I could do the seller financing, let it season for 6 months, pay off my private lenders, all right, hold the back end, or I could create a first and a second note, all right. I could create the first note, sell the first note off to take out my private lenders, and I'm holding cash flow on a monthly in the second position behind the first, all right. That would be my second. My third would probably be I would still look at rentals, but again, you got to be really careful and selectively,
Right.
all right, to make sure that you're getting into them right and that you are in good shape. The other thing I would look at is just finding properties that are under market but are in decent condition. They may be outdated, 1960s, all right, decor.
Yeah.
I tease about the pink bathtub. We all know
bathtub.
that's 50s, I think, rather than 60s, but still. But the old shag carpet, all right.
Yeah.
But as long as the house is safe, it's functional, and you don't have to put much money into it, and you've got into it under market, I turn around and seller finance that thing.
Yeah.
Mark it up, turn around, resell it. With seller financing, there is a huge amount of people out here that don't qualify for the bank mortgages, but they make good income. They make good income. They've got good down payments, all right, and they're appreciative of an opportunity. Now, you still need to do your due diligence. You still need to run them under a residential mortgage loan originator to make sure they have the ability to repay. You've got all the disclosures that need to be given to them in that respect. But you can create that so you've got a wonderful cash flow to you in a first and second in that type of situation, and giving them an opportunity that they would not have so they can get out of the rental game. All right. And have home ownership. They're appreciative for that. And you can sell the first mortgage and get your private money out and still be making cash flow.
That's a great strategy. And I think, in this current market, I agree with you 100%. That's a great strategy. There's a lot of those opportunities. And that's one thing that we didn't talk much about of, what does our borrower usually look like? And, for a lot of you guys that are watching, we could probably say, I don't know about your portfolio, but on average, probably the interest rate on those owner financing properties are somewhere around 10%, right?
10 to 12.
10 to 12%.
Yeah, that's where most of them are. And the question sometimes, even when we've done seller financing ourselves, sometimes you get the pushback from people that say, well, that seems really high. And my kind response is essentially stating that, all right, you do not qualify for a bank loan. Okay. If you can qualify for a bank loan, fantastic. Go get a bank loan.
Right.
Okay. That's where you need to be. But if you do not qualify for a bank loan, all right, we are taking on the risk, and we are not too large to fail, as the big banks got the bailout from the federal government, which we as the taxpayers basically paid for. I don't think taxpayers are going to come and bail me out. Okay. Right. So as a result, you're paying a higher interest rate because you are at higher risk. Right. You're a higher risk individual, but we are willing to take that risk because we believe that you have the things that make for a good potential person to be able to manage this home. You make a good income. You've got a good down payment. You've demonstrated responsibility to us in that respect. But we're still taking on a lot more risk, and that's why. Now, all of the loans that we create, we do not put any balloons in them. They can refinance at any time. So in 3 or 4 or 5 years, they are able to get bank financing and get that lower interest rate. We are perfectly fine with that. And we make that, we communicate that extensively.
Right.
But some people just prefer to do one-on-one.
Right. And, for people that are watching and that are new to the note space, the note investing space, a lot of, one of the most common questions is, I'm sure there's, if these people don't qualify through a bank, that, there's a lot of default in that, to where it actually tends to be quite the opposite.
I can say it.
Right?
A lot less than you think.
Right.
Of all the government-sponsored entities out here, conventional compared to conventional loans, Fannie, Freddie, FHA, all that type of stuff. You know who has the largest default rate? FHA loans.
Yeah.
A 3.5.
Yeah.
And the reason why? They only put 3.5%
Right.
down.
Yeah,
We don't work with anybody unless they have at least 10% to be able to put down.
I was gonna say, you know, one of the biggest, you know, differences is that down payment, right? If somebody, and especially right now, we're seeing it in the market, right? You know, some similarities to 2008, 2009, right? Get into this house, $1,000, $1,500 down. We got all these programs, right?
500 down, 500 a month. Please don't do that. Please don't do that.
So it takes a different person that's disciplined to be able to save up 10% of a down payment.
Exactly.
And that's really the key. And yeah, I mean, they're not going to easily walk away from a house if they put 10% plus potentially renovations plus payments. It's going to be a lot harder. They're going to find a way to get back on track versus a person that said, hey, you know, I put, you know, $3,000 to $5,000 down. It's been a couple years. I've lived here. I'm okay. You know, just walking away. And that's what we're seeing in the market. Is
that's exactly what's happening.
Those are the homes that are getting foreclosed on.
Yeah. One of the reasons why we made 10% is that cutoff that we won't work with anything, with anyone that does not have 10% to put down, is because it does demonstrate that they have some financial acuity, okay, and discipline, all right, to be able to save that money. Now, if the money's just being given by a parent or something like that, that's a different ballgame. Okay.
Right.
We want to be able to know that they've earned that 10%. Right. They've scraped money together. They've saved. All right. They've put sweat equity into that.
Yeah.
Okay. If they do that, they're appreciative of the opportunity, and it shows financial acuity and responsibility from our aspect. Many times this on seller financing, the borrowers do not have credit scores. Okay, so how do you evaluate them? Well, how long have they been at their job?
Right.
Okay, have they are they someone that's like changing jobs every 2 years?
Right.
Okay, or is it someone that's been in the same job for 5, 6, 7, 8 years? Shows stability. You're looking for stability is what you're looking for.
Yeah.
And the discipline to be able to save and the stability. Okay, those, in my opinion, are two critical things when you're looking at non-QM type of loans, if underwriting people that don't meet the bank qualifications.
Yeah, you're exactly right. I mean, there is, you know, a vetting process just like anything else, you know, whenever you own rentals. Obviously, we've met people that buy rentals that the first person that calls on their signs, they rent it to them without doing a background check. The same thing with owner financing. We've seen that there's a lot of bad owner financing deals. And that's why we've, you know, invested a lot of money in our education to be able to do things the right way. And, you know, actually, that's why we're here. We're here at a mastermind event that we're a part of. And, you know, I encourage for people that are watching, you know, people are like, man, I really want to learn more. I know you do a newsletter, tidbits. Where can people reach out and find out more about kind of what you have going on?
You can go to our website. We have a lot of free information on our website at Cassidy. That's CASSIDY investments with an S on the end. All right, .com. If you have a note that you're looking to sell or something like that, we buy notes, obviously, but we have a lot of educational materials on there. And you can also sign up on our website for our Note Talks with Kyle and Jay. All right, we discuss all things notes, similar to what this. So we have deals that we're looking through. We kind of we host that on the last Thursday of every month from 12 to 1 Eastern time. If you've got a deal that you're looking at, we'll work through that and get a second opinion. It's just whatever information. Maybe you're brand new and I don't know how to look at this. That's great. All right. We have probably 8, 10, 15 people that's on there on a routine basis that, you know, some of them are quite experienced. Some are newbies, and it's fine. Don't be intimidated. Okay. Yeah. I would encourage you to sign up for that, even if you can't attend live, because we do send the video out to everyone who signs up. Okay.
Awesome.
And then whether you sign up for that, and then we have a quarterly newsletter that we send out. It's just basically an update of what we've done in our businesses over the last quarter. All right. And at the end of the year, we kind of give a financial synopsis of where our businesses are at. So that's available to our private lenders. It's available to people who are just following and curious about what we're doing. Or if you're wanting to learn more on how we operate and our investing philosophy, that's a great place as well. So, and just for signing up, we'll give you the digital version of our book, Be the Bank, an Introduction to Note Investing. So that's free gratis.
Awesome. What would you say is probably, if you had to give one tip, something that you've learned about note investing to somebody that is wanting to get started, that's maybe on the fence? What's something that you would leave the audience with?
Always have equity to protect you.
Simple, but
It's not difficult.
Yeah.
Because in notes, the ultimate protection is the real estate. So
Right.
if you got a crappy piece of real estate, okay, even though you may have a note, but you got a crappy piece of real estate and there's not much value there, you better hope that note performs, because if it doesn't, you may not get your money back out. But
Right.
if you have a decent, I'm saying, we don't do anything that's in war zones or anything like that. Working class neighborhoods, fantastic land, good land is fine. We don't go above 70% of the value of the property. And understand that values can fluctuate depending upon markets, but we always want a 30% equity cushion in there to protect our money and protect our private lenders if for some reason we would have to take that note through a foreclosure process because the borrower is not paying. That's like the last resort that we go to. There's multiple other things that we can do to help them through a tough situation. But it's ultimately the quality of the asset that backs the note and having that equity cushion that protects you in the long run so you don't lose money.
Yeah. I mean, Warren Buffett, right?
Yep.
Number one rule.
Don't lose money.
Don't lose money.
The second rule. Don't forget the first.
Yeah. And I was going to go into, when you're talking about, making sure that there's protection there. I've seen this, and I'm sure you've seen it too in kind of, the groups and networks, right? Like you said, there's a crappy piece of real estate and somebody's raising money for that crappy piece of real estate. That obviously there's value in anything, right?
Yeah.
Even if it's, crappy or whatnot. But what I tend to see sometimes is somebody may go to somebody and say, hey, I'm looking to, raise capital for this project or this property, and I'm offering, whatever, right? And then somebody says, I'm not, too excited, too fond of it or whatever. And then the person, all they really do is say, well, I'll offer you more. Just because they offer you
that
more.
Doesn't change the fundamentals of the
doesn't
deal.
Change it. And people forget. And it's actually, something also so simple that like, hey, well, instead of, 12%, I'm getting 14%. All right, I'll take it. It didn't make the deal any better.
The deal didn't change. It still may be a crappy deal.
Right.
And, the return on zero is still zero.
Yeah. So, anyways, we'll go ahead and wrap this up, Jay. I mean, I appreciate you taking some time. Where do you see yourself, in the next year or 2 or 3 years? Maybe any surprising data that you've seen over the last couple of months that, you'd like to share? Or
I just think there's a storm brewing. I think this is the time to prepare for that, to be more liquid. I think that is a prudent approach. It's been a long time since we've had a recession. There's been a huge run-up. And I'm not a predictor of doom and gloom, but my concern is that with all of these different factors that are converging right now, when it does hit, it may be really severe. Okay, I hope that I'm wrong, to be honest, but I think it's a time to be very cautious in what you're doing. I'm not saying don't run away from deals or don't participate or don't get in. Just be ultra conservative right now. That would be my one takeaway.
Appreciate it. Well, it's been an honor to have you, and we'll put all your information in the link to the video. And I'm excited to see your journey. It's always excited to hear you speak. I know you've been traveling, so appreciate it.
I have been quite a bit in the last 2 weeks.
Yeah. So thank you everybody for tuning in,
Thank
and
you.
we'll see you on the next episode.
All right. Take care.